Everybody, I got some stories today, so we'll get some going. We'll get this all going here. And Friday was an exciting day. All sorts of things. Anyway, today I wanted to talk to you about the fact that Treasury bonds may not be the safe haven that we've all been thinking. The royal we. Me, on the other hand, that's why in the disclaimer every morning I'm like, Treasuries, be careful. If you're like most Americans in your 40s, 50s, 60s, maybe older, you probably have some money sitting in bonds or bond funds, especially if you have a 401k. Maybe it's money that you've been told to keep safe for retirement. You've been told that Treasury bonds are basically the safest investment of the world, backed by the full faith and credit of the United States government. But what if I told you that some of the smartest money managers on Wall Street are now calling for Treasury bonds maybe to be the riskiest asset? What if the very investments you've been told are guaranteed to protect your money might actually be putting it at bigger risk than anything else that you're invested in? Today, we're going to dig into the truth about Treasury bonds, not the fear-mongering headlines, not the traditional Wall Street sales pitches, none of that stuff, but the real facts about what's happening right now in 2025. By the end of this video, and yes, this is the last day of the first half of 2025, June 30th, 2025. By the end of this video, you'll understand exactly what risks you're taking when you put your money into Treasury bonds and how to think about them in your portfolio. Now, let me start off with a simple question. What exactly is a Treasury bond? Does anybody know? Let me know in the chat. Well, you can think of it like this. When you buy a Treasury bond, you're essentially lending money to the US government. In return, they promise to pay you back with interest. It's like being the bank, and Uncle Sam is your borrower. For decades, this has been considered the safest bet in the world. After all, the thinking goes, the US government has never defaulted on its debt. They can always make more money by printing it to pay you back. What could possibly go wrong? Right? Recently, some very smart people have been asking that exact same question, and their answers might surprise you. Just a few weeks ago, BlackRock, one of the world's largest investment firms, managing over $10 trillion, I think it's 12 or 13 now, published a report with a striking title, US Treasuries, a risky, safe asset. Now, that's not some kind of fringe blogger or conspiracy theorist, or, some people call me a conspiracy theorist, but I have a habit of being right on a lot of this stuff. I guess conspiracies are, a month or two out from being truth these days. So BlackRock is the company that manages more of the country's, I guess they manage more assets than the GDP of a lot of countries when you look at it, that way. So at the same time, we're seeing headlines about foreign countries reducing their U.S. Treasury holdings. China, Japan, some European countries, and they've been major buyers of U.S. debt, but they've been pulling back, some of them for years. And China is actually a very minor holder of U.S. Treasury debt these days. So what's really going on? Are the Treasury bonds still safe? Are we looking at a fundamental shift in one of the world's most important financial assets and markets? So let's start with what's happening right now. In the bond markets, as I'm talking to you right here in June 2025, the last day of June, the 10-year Treasury bond is yielding about 4.27%. That means if you lend the government for 10 years, you lend them like $1,000 for 10 years, they'll pay you about $42.70 per year in interest. Now, inflation is running about 2.4% annually. So your real return, that's what you're actually earning after your money loses its value, is about 1.87%. It's not terrible, but it's not exactly life-changing and exciting either. But here's where it kind of gets interesting. That 1.87% real return assumes that inflation stays at 2.4. What if it doesn't? What if the inflation starts climbing like it did in the 1970s? Let me paint you a picture of what happened back then. I wasn't exactly alive, because some of the younger viewers out there, maybe you don't remember the 70s. Maybe you're young like me. Maybe you missed most of the 70s and only caught the tail end. So inflation was running at a modest 2.8%, very similar to today. But by 1980, it went to 15%. 15% during that same period. Bond yields went from about 16%, or went from 6% to 16%. Now you might be thinking, well, great, higher yields means more income, but there's a catch here. If you owned bonds before that period that didn't mature till afterward, you actually watched the value of those bonds get absolutely crushed. Think about it this way. If you bought a bond paying 6% in 1972, and then the new bonds, you bought that 10-year Treasury bond in 1972, and then by 1980, 8 years in, you got 2 years left on your bond. Those new bonds being written in 1980, paying 16%, who would even buy your old, if you tried to get out of the 6% bond, who would even buy it, right? They'd only buy it at a massive discount because, well, your money's better spent buying new bonds. Some of the bond investors lost 30, 40, even 50% of the money tied up in those bonds during that period trying to liquidate them, even though the government never missed a single payment. You have to basically hold these to maturity. You can't get they're not liquid. They're not safe, right? So even safe investments can lose money when the economic environment changes. And right now, there's warning signs that the environment might be changing. What are the warning signs I'm talking about? Let me break it down in plain English. See, there's money supply issues. No big surprise here. The government has been creating new money at a rapid pace over the last couple of years, and the money supply has grown about 4% annually. That's higher than the inflation rate. Now, it may not sound like a lot, but remember, every new dollar created makes all the existing dollars worth less. It's like watering down a drink, putting ice in the drink. Now, we argue that this money printing is actually higher. We people smart looking at all the thing, we look at this because you have things like US stablecoins, USDC, USDT. You have other foreign banks that are lending money in dollars, but they don't have the dollars, so they're just creating those dollars on account. Then you look at the government spending, deficit financing, Federal Reserve policies. There's new money creation in the system that's not just printing. So it could be 4%, could be 7%, could be some higher number. And the direction, though, is clear. There's more money pumping into the system, chasing the same goods and services, which typically leads to inflation. All right? I've held that this is the false all clear in the inflation, right? We had a spike, and then we think we've tamed it, but I think we're going into the third act of this thing where inflation is going to ramp up again. This is where the risk to treasuries really comes in. Now, the U.S. government now owes over $34 trillion. We're adding about $1 trillion to the debt every 100 to 180 days. And to put that in perspective, that's more than $100,000 for every man, woman, and child, every person, period, in the United States. And it's growing fast. The government borrowing more and more every day. Now you might say, so what? Big deal. The government can always make more money. They can always pay their debts. And technically, you're right. The government can always print more money. But that's exactly the problem. When the government prints more money to pay their bills, it devalues the currency. And when the currency loses value, everything priced in that currency, including treasury bonds, loses purchasing power. Now, there's an international situation brewing too. For decades, foreign countries have been happy to buy US Treasury bonds. We've seen China and Japan, other nations, and a lot of people are under this misnomer that China still owns a huge amount of Treasury debt, but they're actually down to one of the smallest holders currently. And recently, that's all changed. So, like I said, it all changed where China is holding a smaller amount. So we're seeing this, Japan, which is our largest foreign creditor, has been making noises about using their they only hold about 1.1 trillion in treasury holdings, but they're trying to use it as a bargaining chip in those trade negotiations. Trade, tariffs. The deficit, this deficit thing that Trump's working on, trying to get the tariffs, trying to get the money out of the other people. So Japan's actually using their 1.1 trillion as a bargaining chip. And when your biggest treasury customer starts backing away, usually not a great sign for bond market prices. So falling prices mean rising yields, which, it's when you have less people coming to the bond auctions that they do, the prices go up, which means losses for existing bondholders. When there's less people wanting to buy current bonds, those yields go up. And when those yields go up, that means everybody holding safe assets, they're now sitting on a loss if they need to liquidate. Now, I don't want you to think this is all doom and gloom. There's smart people on both sides of this debate, and it's important to hear all perspectives. So on one side, you have the traditional financial institutions like Forbes, brokerages, financial advisors, all calling low risk investment. Treasuries are low risk. They're the best things you can park your money in. The argument's solid. The U.S. government never defaulted. If you can hold them to maturity, the treasury market, it's super liquid, right? You don't really have giant risk of loss if you can hold it to maturity. You're probably going to make money, but you may not keep up with inflation. They pointed out that even during the 1970s and into the 80s, while bond prices fell, when you had to liquidate, investors who held to maturity still received the principal plus interest. And yes, the purchasing power was eroded by inflation, but they didn't lose that initial investment. Like, it came back to you. So while you may have been behind, it was still safe. These experts also note that treasury bonds serve an important role in a diversified portfolio. When the stock market crashes, it can lose 20% like we did recently, 30, 40, 50, 60, almost 60% like we did in 2007. And we can see a flight to quality. And it's happened repeatedly throughout history during market pullbacks. But on the other side, you have institutions like BlackRock raising serious concerns that things could get a little crooked. It's kind of noteworthy because they're not just talking. They're actually putting their money where their mouth is. They've actually taken short positions against long-term treasury bonds in their portfolios. Think about that a minute. Arguably the world's biggest money manager of, retirement accounts and stuff is actually taking short positions against long-term treasury bonds right now. In other words, they're betting that the bond prices are going to fall. Bank of America has also been issuing warnings about cracks forming in foreign demand for US Treasury bonds. They note that foreign demand is atypically low and warn of a potential future bond market volatility explosion. Now, even more concerning, some analysts point to what happened in Russia's foreign reserves in 2022, when Russia invaded Ukraine. The U.S. and its allies froze hundreds of billions of dollars in Russian assets, including their treasury bonds. This demonstrated that even safe government bonds can become worthless overnight if the U.S. government backs up against you. Now, I'm not suggesting that the U.S. is going to freeze your and mine, any American citizen's bond holdings, but the Russian example shows that there is some political risk against something that was never supposed to apply to treasury bonds. It's a risk. And I think foreign governments, foreign investors, they see that now. It's kind of a very real risk in our interconnected world. So if you're not in the U.S., it could be a problem, right? Russian investors, they weren't involved in the, oligarchies and all those things. They weren't actually involved in the war, but their investments got frozen. So where does this all leave us? Are treasury bonds safe or risky? The honest answer is it kind of depends on what you're thinking. If you're a conservative investor in your 60s, 70s, you plan on holding your bonds to maturity, you're probably primarily concerned with preserving capital rather than trying to go for aggressive growth. If treasury bonds they can still make sense in your portfolio. The risk of the US government defaulting in the next few years, probably essentially zero. But if you're in your 40s, kind of more my age, maybe 30s, maybe even 20s, well, you could have a number of years to retirement, 20, 30, 40 years to retirement. And the calculations get a little different. Over that time frame, inflation risk could become more significant, even modest. 3 to 4% inflation could cut your purchasing power by over half over a 20-year time frame. So let me give you a concrete example here. Let's say you put $10,000 into that 10-year treasury, and you bought that 10-year treasury today at that 4.27%. In 10 years, you get your $10,000 back, plus you get that, $42.70 in interest per year over 10 years. So, it adds up a little bit, but you end up with about $14,000 at the end. Now, $14,000, what's it going to buy you in 2035? If inflation is just 3% over that period, well, hate to break it to you, but over a 10-year period at 3% inflation, well, it's going to take $15,000 to buy you what $10,000 buys you today. So even though you made money nominally, you actually lost purchasing power over the long run holding that money in treasuries. And that's assuming that the inflation stays at a modest 3%. If we see that third act of inflation ramping up like I've been kind of thinking about, speculating, well, we could see major erosion in purchasing power. And that's why some financial advisors, investors, I'm not a certified financial advisor. I'm not playing one on YouTube, but that's why some of them are now recommending Treasury inflation protected securities, or TIPS, instead of regular Treasury bonds. These TIPS adjust their principal value based on inflation, so you're protected against erosion of purchasing power. The downside is that TIPS typically offer initially lower yields on regular bonds. Another consideration for your portfolio allocation, if you're concerned about bond risk, I mean, you can eliminate bonds entirely. You can just move into those AAA rated collateralized loans that we've been talking about. And it might mean you reduce your treasury allocation, right? Especially if you're later in life and you want to, get out of that risk. You can go to stock market, real estate, commodities, and a AAA rated collateralized bonds like PAAA and JAAA, those two tickers. Now, let's get practical. If you're watching this video, you're here with me right now today, what should you actually do with your money? Don't panic. That's the first thing. The bond market isn't going to collapse overnight. Treasury bonds aren't going to suddenly become worthless. They're probably not going to, they may lose value, but they're not going bust. All right. You can lose money trading them. That's what I always say. So you got to figure out what the risk is to you. If you're holding on to the old rule of thumb, you're, get up there in your years, maybe 45% bonds at you're 45 years old, that rule where take your age and that should be what you devote to treasury bonds. You might want to reconsider that, especially if you're in your 40s, 30s, maybe even 50s. Many financial advisors are now recommending lower bond allocations, especially for people in their earlier earning years. Now, if you're heavily invested in long-term treasuries, maybe those with 20 or 30-year return horizons, you're taking on significant interest rate risks when those interest rates rise on those long-term bonds. And you can't get out of them. You got to hold them to maturity. So when rates rise, long-term bonds can get hit much harder than short-term bonds. That's why we're seeing, somebody asked me about the bond inversion rate, and this is kind of why this is happening right now. And you can consider building something what's called a bond ladder. That means instead of buying bonds with different, that means buying bonds with different maturity dates. So you buy some 2 years, some 5 years, some 10 years, and you don't just allocate everything to one maturity rate. And as each bond matures, you can actually collect that money and roll it on out further. And that's a smart thing to do, even if you're just using money guaranteed to you by the bank. They do their alternate investments, their secure deposit. Blew that right out of my mind there. The that they yeah, gone that word. Anyways, sorry. So much for being live, right? And so tips, the inflation protected securities, treasury securities might be one way to look at it. Yeah, deposits. What was it called? Security certificate of deposit. If you CDs, if you buy CDs, you can layer them in 6 month, 6 month, 1 year, 2 year, 3 year, 5 year, and when you get your CDs, that gives you a constant recycling, so that for bank rates, they're CDs. That's it, and that's beneficial there too. So doing that same process in bonds actually helps you roll that money forward and collect current rates as that money comes into maturity. So don't forget about diversification. And I do the 50K challenge. I show you how to actually make money reliably, and we're doing pretty good so far, even though I've only been doing it for 2.5 months. So there's something else that people don't consider, and that's your human capital. If you're still working and earning a paycheck, this is one thing that Goose harps on in our Termite Trading Lab groups, our in-person meetups. Earning a paycheck is the fastest way to build up your retirement and your fastest way to build up trading accounts. You got to be able to put that money from your job into your trading accounts. But your salary probably going to go up over time with inflation, because that's kind of the way this all works, which means you can afford to take a little bit more risk with your investments if you're still working, which a lot of us are. The bottom line is the old set it, forget it approach, well, might not be, if you're doing that 401k thing and automatically does it, maybe that's not the best way to go about it. So that 60-40 bond allocation thing, maybe not the best way. Now, as we wrap this little segment up, let's zoom out, look at the bigger picture. What we're really looking at here isn't just about bonds. It's about fundamental shift in the global financial system. Now, for the past 40 years, we've lived in a world that generally has declining interest rates. We've lived in ZIRP, zero interest rate, for most of my adult life. It's created a perfect environment for bond investors, but that era of time in our timeline appears to be coming to an end. We're now entering a period that may look more like the 70s and 80s or something else in our past timeline. Higher inflation, more volatility, especially in interest rates, greater uncertainty about the value of paper currency. And in this environment, the traditional 60-40 bond portfolio might not provide the protection against downturns that investors expect. So this might mean that ultimately, it doesn't mean that the sky's falling. The U.S. economy is still the largest, biggest marketplace in the world. We're very innovative. We've got AI, we've got technology, we've got crypto. We've got all sorts of things on the horizon that can make fundamental shifts that we're not fully taking into account. This doesn't mean that investors need to think, don't want to get trapped in the same old thinking. You need to keep your mind open, and there's not a risk-free rate. That risk-free rate that they talk about may not be so risk-free anymore as we change out of this ZIRP environment that we've been in. ZIRP being zero interest rate policy. And some investors have already adapted. You've got to be on top of this game. That's why you're here, hopefully, paying attention. So you've got to be an active player in this whole game. And thanks for watching. Let me know in the comments if you've enjoyed this. If you didn't enjoy it, if you have different comments or, whatever it might be, let me know. Feedback on these research projects I've been doing. I worked on that one last week into this week, so that was a bigger one. And hopefully everybody understands the risks associated in those treasury bonds. And all trading involves a substantial risk loss. Past performance, not necessarily indicative of future results. Presentation intended to be informational, educational, fun, entertaining. Not a recommendation to be buying anything at all. And if you need, so don't trade stocks, options, bonds, forex, futures, cryptos, treasuries. You might lose money if you trade them. If you desire somebody to tell you what to do, that's not what I'm doing. If you want personal financial advice, hiring a consultant financial advisor. Welcome to the show. S&P popping again today. And like I said, Friday was an interesting day here. Let's see. Snooze on the upgrades. And let's see if I can pop this baby out. Pull this baby over. Check this out. This happened at my office on Friday right here. Wasn't that fun? That car, I guess they were cutting through our parking lot. There's a side street over here to the, I guess what would be the right of the picture. Everything's flip-flop for me. And they were cutting through going to the left, trying to avoid the intersection that's right to the top of the picture. And I guess kids distracted driving, whatever, they didn't see the planter. They ramped up on it. There was a stump in there. Maybe they got hung on the stump. It looked like those wheels were basically, it didn't have enough oomph to get over that little planter. I guess their exhaust caught the mulch on fire. Then the mulch caught the car on fire. This went down very quickly. The tires exploded, shook the whole building when that happened. Fireballs, giant fireballs. And yeah, that went on for like 2 hours on Friday afternoon. That was exciting, fun-filled. Anyway, welcome to the market today. Let's find out how we can try and make some money, shall we? We are pushing up and completing the 2007 danger pattern that I've been talking about. We blasted right through all of these. Let's we've got all this stuff drawn on here. Let's just kind of erase it at this point. Clean slate, clean picture. On this weekly chart, we set up this market roadmap bounce. Highly likely we cruise right on up to 63.45. Now, that doesn't mean we can't retrace all the way back down to here before we do that. But what it does mean, 75% of the time on tens of thousands of these trades that I've back tested, 75% of the time, we are going to hit this purple line before we go below that low. Now that we've set this up right here. So we're likely, I've been expecting a dip back in here before we popped up here. Been expecting that for, 2 months. As we come into July tomorrow, but no pullback so far. What this has done is set up the pattern from 2007. And if you haven't seen this before, here we go. We chopped around here, we dropped out, tagged the roadmap line, ramped up. Now, when you look at this right here, draw it across, we actually spent a few candles going higher. And that was cool. It just crashed. Awesome. So when we draw the red line across there, we poked out. We might have 2, 3, possibly, it doesn't have to match exactly. It could be 4 or 5, candles we get up here. We may see that one final big spike that takes us into this 1272. That's up there around that 6,600 area that I said might be the top. Be careful. And so this could take us out through July and August, maybe, possibly even into September. But if and when we come back down, if we're doing the 2007 thing, could lead to a bigger market correction. Since this is higher time frame, the 2007 pattern is actually the 3-day chart. This is actually the 1-week chart. Well, 2007 led to a 57% correction in the market. That could take us back down into the COVID lows. at the minimum. That'd be a pretty wild return, right? Return of price back down in here. Look at that. That would be a pretty wild ride back in the 2000s. Evaporate all the market gains of the last 5 years. So that's the real risk in the stock market right now, too. We could get one of these bigger corrections. So looking at the S5 TW, stocks above their 20-day moving average. Take this off log so it looks proper. This is a giant market oscillator. Doesn't go below 0, doesn't go above 100. You can't have more than 100%. So this is the percentage of S&P 500 stocks above their 20-day, and we're hanging out right under here. We may make another spike. We actually tagged the high 80s, and we may make another run up in here. Look at the stocks above their 50-day moving average. We did spike this one out. Didn't really get a close up above 80. So we may take this on up. A lot of times if we tag 90 on this chart, we're set for a big correction. 90 is usually the extreme. When we tag 90, we usually take a big correction. And that one took a big correction and then came back up, did a lower high above 80 before we actually went to the bottom. So just because we tag 90 doesn't mean we're destined for 20, but it does mean that we're probably going to get a pullback. So if we poke out again, and especially if we tag 90, watch out, stay frosty, my friends. And then looking at the stocks above their 200-day, we're still at 51%. So that means 49% of the S&P 500 stocks not above their 200-day. That's not exactly bullish. And when we go look at RSP, this chart looks eerily like the Russell chart. This is when you equal weight the S&P 500. So be very, very careful here. We could see a large correction take place. So we might grind it higher for a few more days. And we've been chopping higher, and then we kind of took a accelerated path higher on the S&P here. We still have those downside risks. Well, we might be cruising on up to the 6,600. And I kind of speculated that we might do that by October. Looking at NASDAQ. There's the upside target. Probably going to hit that 23.4, 23.5 right there. Put it on long mode, 23.5. Probably going up there. Be careful though. As soon as we tag it, any of these candles can be the last candle higher. There's a time for caution, not for getting overly aggressive. This one, still not really participating. Remember, 80 to 85% of the country works in the companies associated with the Russell 2000. This is still significantly below the high we made back here and has a bearish setup to go much, much lower in a very fast manner. Thought there was I don't know, the Russell. There it is. R2FI. Look at the R2FI. This one's actually banging out right here on the 50-day. And then R2TH. Oh, R2TH. Stocks above the 200-day. We're hanging out down at 39%. Somewhat bearish. Yeah, the 80 way up here. We don't even look at that. This hasn't hit 80 on stocks above their 200 days since all the way back here in 2021. It's been suffering pretty bad here. But it's probably not bottomed out yet. How is the volume on these index highs? How is the volume on all these index highs? So that there's not necessarily volume on indexes. I'm not sure I understand your question fully. But we are seeing a lot of retail come in. And a friend of mine, so I don't know if I posted it where I can pull it up or not. A friend of mine on X tweeted he has a lot of retail. I mean, not retail. He has a lot of investment managers that manage retail money. He's saying that those retail or those investment manager clients are seeing some of their a lot of us have notorious habits of coming into the market at certain times, and for people that manage a lot of money, they see patterns, and there's a pattern right now that's showing up and becoming very evident that people that are typically go all in at the tops and sell everything out at the bottoms, those people are going all in right now. And the friend of mine tweeted about it on Friday. I posted it to a few of my channels. Let's see, I was looking for it here. See if I can find it where I can show it. I don't actually see it where I could pull it up on this screen. It's Avi Gilbert, and he runs ElliotWaveTrader.net. He put it on X for everybody to see that his investment manager clients are seeing people go all in at the top. What would be perceived as a top. So late to the game, we might be seeing the topping process, but it could still take us another few weeks. So be careful out there. Gold kind of has this path. I've been looking for the next support zone right down here on the way down. This is running a little slower. We were running faster and now we're running slower. We could see gold erode back down in here in the coming weeks. Bitcoin trying its darndest to break out. Should probably put it looked really spicy here, but now we're actually getting a little pullback. Yesterday was looking really nice. Today, pulling back, grinding a little bit. We may get a pullback in here again before we can go higher. This whole big thing, almost perfect, right into support. Support's going higher, and we're probably going to do the final move. I expected this to take place back here. It took us a bit longer. Getting the timing down is hard. I don't expect this whole move, though, to take longer than, say, October, similar to what I expect on the S&P. But, again, this whole thing could play out. All of a sudden, it could go faster than I expect, and we could end up right up in here at the targets. Ethereum turned around, and David A., a man, if you haven't listened to the Crypto Power Plays thing, especially the bit I talked about on Ethereum right near the beginning, you gotta go look at that, has the chance to thread the needle and save the day. It's interesting. Got to pull back here, and if it can manage to save all this, resurrect the bullish pattern, it has a very bearish setup with lower highs. But if it can thread the needle and do something more bullish, we could actually see this up in here very quickly. It'd be an interesting play. NKD, look at that, attempting, after a couple strong days, attempting to break out. As I talked about, if we actually do that, it could spark off a blow off top type situation where we ramp this thing from 40 up into the 50,000 area. That's global liquidity indicator right here. we could see the US market kind of do the same crazy kind of move right there. Dollar did push lower in late last week. Finally got those downside targets. Parked right in there Thursday, Friday, and today. Could push on down. Still possible. But this holding right there indicates that we may get the bounce. That roadmap line coming down. So we may see something in the 101 area on the next move. This looks complete now. As I mentioned before, that looked incomplete. Now it looks complete. Even right there, I was like, that looks incomplete. Now that whole move right there looks complete. So we're set up for a potential bounce, and then the nature of that bounce sets up whether the trend is going to be up or we're going to get more continuation lower. There's still the possibility we come all the way down into the 90s, the low 90s, or at 90. But things are looking like it may bounce higher again. That upside target could be up here around 120 to 140 for the dollar. Look at the Mag 7s. Apple's still not participating. Apple usually, you know, for years the saying's been, so goes Apple, so goes the market. Apple's not been moving at all. Yet the S&P and the NASDAQ up at all-time highs. Apple losing favor here. Amazon in this danger zone. Can we break out? If we do, we set the stage to go on up to 254. Right now, it still has the same downside potential as Apple. Google still has that same downside potential as Apple. Be very careful. This is kind of a corrective move up. Can easily lead to a move lower. Meta pushing on up. Can it break out? This is pushing the extremes of the pattern, but could still lead to a big downside back to the lows. For a while there, I mentioned that it could easily be a double, and we could go on up and double it. I mean, it could push the extremes here. Microsoft still has that upside target around 500. Actually, log mode 508. There, we may see it come back down before it pushes on up. Nvidia pushing on out. 164 is the target. It can still go down pretty violently too. Tesla grinding through this thing. We had the first after the market closed on Friday, they did the first ever customer delivery, fully autonomous from the factory to a customer's, location with nobody in the car, no remote driver, no nothing. The car did it, the whole thing itself, left the factory, drove to the customer's location, and delivered itself to a customer. That happened on Friday for the first time ever. It's a changing world out there, I'm telling you. Things are getting interesting. So Tesla stock, first move down, retrace, second move down. If we hold support in here, support's breaking on through resistance. If we set up that bigger pattern, similar to Apple, first move down, retrace, second move down potential, could be down to 100. I am long Tesla. It's the only one of the Mag 7s I am long. So how do we make money today? Everybody says, hey, JT, things are a little crazy. What do? I go after bullish charts. That's what I'm doing in the 50K challenge. Right here. That did not break through. It didn't close above 36. So I actually got to keep the shares and all the money I had on the sold calls. Was ramping up in the pre-market, taking it back already. You can see my 50K challenge account over here, all-time history. I'm at 6.9K now. Just this year, 4.3K. We did take one little loss on VIX, but I just keep climbing it. Right there. If you want to follow on, it's on K-Info for everybody for free. Channel members, I try to give you an update when I've got updates to give you. So if your name's in green with a little star, I give you updates, screenshots from my account with the orders open, and we'll see. So there you go. And 98% win rate. I mean, I started trading this basically tax day or tax week. Start refunding this account, or funding this account, and we've been doing pretty good. You know, the last month, 2.39, and that just has to do with the way it accounts for the trades. Robinhood says I'm actually up a little over $3,000 for the last month, but I have this Rocket Lab open. Bought it back down here at 25, sitting at 36, well, a little under 36. I would not sell puts on this right now. Has the potential to pull back before we go higher again. Be careful. I'm selling upside calls. Probably going to target 40 to 44. But I'll have to make the decision after I get off here. Other things that I'm kind of bullish on. You know, Nike, I was pretty bullish going into earnings. Now, this probably needs a pullback, so be careful right here. Other things. Merck here. I actually got put shares at 79.20. Or I guess it was, I sold 80 calls, got put shares. So I'm sitting at a 79.20 cost. Actually, it's probably a little lower after the calls I sold last week. But it's hanging in here with a measured bounce. Now, it can pop, but it could push on down back to the lows. If we start back below here, it may turn into something I've got to go a little longer term on. This looks like this low was the bottom. All right, I'm not chasing Mag 7 stuff that looks like it can drop significantly. Tesla, I think that has a big upside potential, and the premium is absolute wild on that thing. I had 330 calls sold last week. I didn't get called out. And go again. I actually rolled into 340s for next week. These are some bullish ideas that I have out there. A lot of people want me to share more ideas on what charts I'm actually watching. So it's kind of going through a few of these. Some other ones, like DJT, it keeps grinding into the support. Look how little movement this has had in that number of candles right there. You know, even this was a bigger volatile environment. And this, usually we get a little consolidation before we get a bigger move. I think that bigger move for this, probably up. I have some shares I got put. I'm sitting on that one too. Another one I've been pretty bullish on, this one. Nice fair pullback, holding support. Looks ready to pop, and this one could take it up here. 115. 115. Some other ones, let's see. This one looks like it potentially bottomed here. Got the downtrend of highs, roadmap line, resistance. If we get above that, we can go substantially higher on lows. Despite the home builder kind of roughness, Lowe's has an upside potential. Home Depot also has nice upside potential. 458. That actually has a much cleaner potential measure bounce. Celsius, I've been pretty bullish on. We may see this rally on up to the 54 target and retrace. I actually quit trading it because I expected a pullback. I got called out my shares, and I've just been waiting for that pullback. May never happen. It may just go ripping. This thing could be up here at the target, 160. Here's one I keep making money on. Delta. This one didn't actually get the bigger pullback that I kind of expected. They first move down, second move down. We actually got that. We got the second move down, but it didn't go nearly as deep. That's kind of more bullish. If this actually breaks out right here, we can see a large upside. My bigger target on that one up here around 110. 50 to 110, that's a pretty big upside. Just going back for a second. Let's go to a clean chart. Holy, fat fingers. This right here, that move, that move, that move. Look at that crazy potential right there. If that thing shot up. Now, not just that. This move, this move, this move has potential right there in the short term. And then a retrace and a push on up. That kind of number. That's why I'm going after these charts that have this bullish potential in them. Now the one right, MTN, get the right letters in the right order. This one also might have bottomed in a long-term correction here. Could be set for a bigger upside. Shopify is another one that I'm looking for a nice breakout here. Now, as we go through stuff moving today, keep in mind, not everything's great, all right? These were things moving $2 or more in the pre-market. The gainers were things moving up. That's a target. Goldman Sachs coming into financial earnings. We may, because these are hitting upside targets coming into financial earnings, we may actually see a negative reaction on financial earnings. Goldman Sachs hitting target. JP Morgan hitting target. Bank of America, almost a breakout. WFC, almost a breakout. These in the coming days may actually push on higher. And it's possible we see a spike on WFC and Bank of America on earnings if they're not up there, and then a pullback. So JP Morgan already hitting that resistance, could spike on higher and then get a pullback. Oracle, right up to the targets. Pushed up into the 1448, consolidated, and shot the next target. Be careful, this one may pull back. I was bullish on Oracle, now caution, we're hitting upside targets. Same on Rocket Lab, that's why don't sell puts up here. This may experience a pullback. Robinhood, I was pretty bullish on that one. We're now pushing targets. We could go on up to 109, but we're due for another pullback here. Be careful. That's what I gotta say. FSLR, still not breaking out higher. This has potential to make a lower low. GMS, potential to rally on up to 114. ARTO, biopharma, stay away. Not enough candles to do anything with. A little crazy. AppLovin, that has that Mag 7 Apple kind of potential to go down again. Be careful. If we can hold here and turn higher, 602 on the upside. GE Veranova keeps pushing out targets. We could rally on up to 638. GE itself, back to the high. Small time frame, could have a 264 upside. PLTR, watch for that one to come back to the roadmap line. We hit the 1272 at 149 right there. Watch for that to come back down. MSTR, grinding in here. I do still expect this to tappy tap on roadmap line. Another one I'm bullish on, Coin. 396. When we hit that, watch out for a pullback, but could set this up to go on out to 440. RKLX is Rocket Lab, 2x leverage, PLTU, another PLTR, 2x leverage, AVGO, hitting targets. Watch for the next pullback there. Bulls, that's a 3x leverage. Be careful on leverage. HURN, might be set for a bounce here. 158. Sezzle just keeps rocking and rolling. We might be rallying on up to 300 there. Coin already hit. Google already hit. That's first move down, second move down potential. JNPR, Juniper, crazy pop. That's just been nasty sideways action though. Be careful, that's going to be up near the targets. And it gave you no chance to get in. So possible to rally on up to 40 there. W buy. We buy global. That looks nasty. Don't touch it. Karoo back on the list. HNG Hinge Health. Not enough candles to do anything with. Net hitting target. Could go on to 212. Core weave. Be careful. We're kind of stalled out here in between these fibs. That's a heck of a move. We may see a retrace back down in the 100. You know, it could be a violent $60 retrace. Hold in here and then go on up. Be careful. We might see some volatility in core weave. BE, Bloom Energy. This has got a potential setup here with this high, this low. If we close up in here today, we might be able to set this up for 32. VST set for 224 up there. FAS. It's been lagging behind here a little bit. So as we've seen financials pushing out, this has upside potential. 209, 210. CLS, 164. Probably going to get up there. HPE. Out of HPE and HPQ, HPE definitely a better chart. This setting up the potential to rally on up to 27. XCure. It looks kind of bad. Be careful. That may come back down. It's got a reverse split. That's danger zone, baby. Don't touch that. Reddit. Grinding at that 618. If we can get through it, things could turn to the upside. I've been kind of bullish on it, but right now it's on my wait and see list. It's at that resistance point. If we pull back, I'll be selling puts again. If we break out, I may just wait for it to get up here before it pulls back. You know, I need a pullback. Pull back to support, that'd be great. Pull back to this support, great. If we start breaking down though, we may go visit the lower low. Disney, maybe finally bottomed out here. 125. Got a, this could just be a big correction here. And we still get this lower low I've been looking for on Disney. I would not say that's an all clear. Odd. Pushing on else. Baby 106. Robin Hood 2x leverage. Be careful. That probably needs a pullback. TECO could pop on up to 135. Cold. Grinding in here. SMCX. Another leverage. CMT. That's a downtrend. Downtrend all day. Now, this could be bottomed out. That did a first move down, second move down. Still well below the resistance. 155 if we can get above it. That orange zone there. We're going to have to break up through it to get the upside 155. KKR. And pushing up above that 188 upside potential. ANET. Be careful, we're in this danger zone. We can pull down again. It's possible we bottomed out. That's a sloppy move up. Looks like 5 up. We might get a retrace, hold a higher low. That would be the time that I would be after that one. SYM. Look for that to pop on up. That's a pretty clear, clean breakout. Even though it was down in the pre-market, it's now up. Look for that to rally on up into this 51, possibly 60 area. And if it gets to 84, that's really bullish longer term. FTV. Whew. Yeah. Ouch. Dang. No opportunity there for me right now. Zscaler. Yeah. We didn't go as deep as I wanted to, but we are getting up to the upside targets here. 459, 500 probably in the path. NXT. Look for that to return to the roadmap line. So be very careful. While that could be enough on a smaller time frame, we did tag the 4-hour right there. Clean it up, make it a little cleaner here. Tagging that 4-hour roadmap line, that could be enough to start another rally higher to 64, 65. But that could come on down to the daily roadmap line right here, 48. Oil, nasty. NEE, not really showing any kind of committal to going higher so far. Could be complete on the correction, but that also could go one more. Like it's not a very clean move up off the low. There's plenty of other stuff to look at. That is why I don't trade biotech. Gorilla Group Technology has the potential to make a first move down, second move down. First move down, Control C, Control V. We need to be up through resistance. It turned down at resistance, so could be working on a second move down to $9. ALV, enter the resistance. CYN, CNR, potential to push lower. So things that are set up for potential entry today on the daily charts. This one has that pattern that's, I don't really like this. So when you see a watermelon seed squeeze like this, why do I call it a watermelon seed squeeze? Because when it squeeze, pinch and squeeze a watermelon seed squeeze, it can, it can pop or it can drop. Like you never know quite where it's going to go. You know it's going to go with force. So that's why I call it a watermelon seed squeeze. But so this particular pattern, though, gives me a little clue. This, probably an A wave. This triangle is what we would call this in Elliott wave speak. Probably a B wave. Continuation would be a C wave down. Now, it doesn't have to do this. B waves are typically where you see triangles. Now, the reason it's difficult to count, because was this the A wave or was this the A wave? If that was the A and this is the B that ends up down here, the C wave could be up. That's why these are so difficult, is like you don't know if this was the A, is that the A, or is this the A? I don't know which way A was. Very difficult here. And you don't really know until the end. So that's why they are somewhat unreliable on trying to trade for that. Right now, the way this very enthusiastically came down here and then just kind of went sideways, not really interested in trading it as far as a high probability trade. Dix, though, look at this. Even though I did expect this to go a little lower, this one could play out into resistance on the bigger swing. Has that potential move right there. Look at the statistics. That's not good enough. That's not good enough. And that's just kind of in line. So I probably wouldn't take this one, but it's not a bad potential pattern right there. 75% likely to play out. DXPE, same thing I was talking about on CNO. A little less volatility, but same sort of pattern there. This has the move down right there. Potential to go on up to 97 FMAO. Don't like how most of the price action's been below the roadmap line lately, but that's still a valid target, 2760. GTLS, same story. Don't really like how a lot of this price action's been below the roadmap line, but 182 is the upside. Statistics not looking good on many of these. Right here. Potential to come up 30 on the upside. PRLB. That one did not trigger the bot. Be 43.97. Ferrari. Yeah, we still have the bigger swing, 529, but this smaller swing right here. This high, this low. Puts it right back down, lower high at 507. RYI. Yeah, that I wouldn't touch this. That bounce is actually below the roadmap line, and 23. That's a downtrend all day. Be careful. Sky W, Sky West. This high, this low. I would wait for the close above the 109. Bigger picture. SN has this. We're seeing a lot of these sub. We've got these big swings, and then we've got these sub swings. 109 upside. SNX. Yeah. Not sure why that one triggered the. Oh, the split. Yeah. It finds it. The Python code has trouble with splits, recent splits. And Veil, that's been just choppy. Has an entry back here. All that price action is under the roadmap line. That's a downward pressure. I would be very careful chasing that one. I don't think it. I mean, it has the same probability to work out as all the other ones, but not very strong pattern to me. That is a big downtrend that has not been able to get any price action above the roadmap line since back here over a year and a half ago. Be careful out there. And my bias for the day, for those of you still hanging around with me, I appreciate it. And here we go. Bias for the day, probably pushing on up over the coming days. Now, that doesn't mean we won't get some sort of pullback again, but probably upward bias for the next few days until we get 63.45. I don't try to guess short term QQQ 500, 550 tomorrow. I mean, looks like we already hit it. So, being above it tomorrow? I don't know. Already tagging it, so might get a pullback. That's typically we see a pullback, build up support before we go higher again. So there you go. Have a great day, everybody. Be careful out there. The money you save may be your own. I'll be back again. Same bat time, same bat channel tomorrow. I'll be in Discord. Got all sorts of things cooking here. Have a great day. See you guys.